You know, most managers look at the millions sitting in their company's retained earnings account, and they see, well, absolutely free money.
Oh, yeah. Constantly.
Right. Like they look at that massive black number on the balance sheet. Think about the fact that they didn't have to grovel to a bank to get it.
They didn't issue any new stock.
Exactly.
Yeah.
No new shares. And they just assume it's theirs to play with. But they are dead wrong.
So wrong. I mean, it is the ultimate psychological trap in corporate finance.
Right. And today, we're exploring exactly why the cash sitting in your own corporate vault is actually, shockingly, one of the most expensive things your company owns.
Because we are wired to think that, if we already possess something, it doesn't cost us anything to use it.
Exactly.
But in the architecture of a firm, capital is just a factor of production. It's like the steel you buy to build a bridge, or the electricity you use to keep servers running.
Right. It's an ingredient. Welcome, everyone, to this deep dive. We have a highly targeted mission for you today.
And every single cent of that capital carries a very specific, often invisible price tag.
Yeah, and this conversation is custom tailored for the MBA student, the ambitious business learner, or, anyone stepping into a boardroom who absolutely needs to master the mechanics of corporate finance.
Survival knowledge.
It really is.
Yeah.
We're pulling our insights straight from Unit 11, a comprehensive corporate finance text, and our goal is to completely demystify the cost of capital.
Which is, frankly, the single most important skill a financial manager can possess.
Totally. We're going to extract the core concepts, bypass the mind-numbing algebraic recitation, and translate those intimidating formulas into the actual strategic mechanisms that drive multi-billion-dollar decisions.
Because if you do not know the precise price tag of the money you're using to fund a new product line,
Or acquire a competitor.
right, or build a manufacturing plant, you are flying completely blind.
By the time we're done here, you won't just memorize a formula for your exam. You will understand exactly how a company decides what its money actually costs.
You might think you're generating a profit, right? When in reality, the structural cost of your funding is just slowly bleeding the enterprise dry.
It's terrifying. So let's lay the foundation. Before we even consider looking at a specific funding source, like debt or equity, we have to understand the fundamental narrative.
The why behind the math.
Right. What does cost of capital actually mean in the physical world of commerce? Why is top management so deeply, almost unhealthily, obsessed with this one specific metric?
Well, the text defines it beautifully, actually. The cost of capital is the minimum required rate of return that a firm must absolutely earn on its investments.
Just to keep things flat.
Exactly. Just to ensure that the market value per share remains unchanged. It is fundamentally a benchmark.
The hurdle rate.
The hurdle rate, yes.
Meaning it's the absolute minimum bar you have to clear just to justify waking up in the morning and turning the lights on. It's the baseline of survival.
That's exactly the right way to frame it. I mean, the investors who supplied the company with that capital,
Whether they're bondholders lending cash or equity shareholders buying stakes.
right, they expect a certain compensation, they're separated from their money for a period of time, and they're taking on a specific amount of risk by giving it to your firm.
Instead of just, putting it in a risk-free government bond.
Precisely. And the greater the time horizon and the greater the perceived risk of your business model, well, the higher the return those investors are going to require.
So the required return, from the perspective of the investor, is literally the structural cost from the perspective of the company.
It's two sides of the exact same coin.
Wow. Okay, so that establishes what the text refers to as the golden rule of corporate finance, right?
Yes, the golden rule. So suppose a company aggregates all of its funds, and the average cost of that massive pool of money is denoted as K sub O.
Okay, the overall cost of capital, K sub O.
Right. The company then takes that massive pool of money and deploys it into real-world activities, building factories, marketing campaigns, R&D.
And those activities generate a return. Let's call that return R.
Right, so the golden rule dictates that R must be greater than K sub O.
The return on the invested money has to be larger than the cost of acquiring that money. I mean, it sounds simple when you say it like that.
It does, but you'd be surprised. If R is greater than K sub O, you are creating wealth for your shareholders.
But if it's not,
If it's not, you are actively destroying value, even if the accounting profit looks positive on a basic income statement.
that's the part that trips people up. And the significance of that benchmark just cannot be overstated. It literally dictates everything a firm does.
It drives capital budgeting decisions.
Okay.
You know, which multi-million-dollar projects to accept and which to just throw in the trash.
It determines how the financial structure is designed, right? Forcing managers to find that optimal mix of debt and equity.
Exactly. It's the measuring stick used to evaluate whether top management actually deserves their bonuses.
It even formulates dividend policy. Like, the decision to retain profits or pay them out to shareholders hinges entirely on whether the firm has internal projects that can beat that specific cost of capital hurdle.
Right. But to truly internalize why this matters, we have to talk about the concept of opportunity cost.
Oh, yeah. For an MBA student, this is the foundational bedrock of all economic thinking.
Absolutely. The text explains that opportunity cost is the rate of return foregone on the next best alternative investment opportunity of comparable risk.
Which is a very academic way to put it.
True. But the text uses a very clean, relatable example for this. Imagine you have 10,000 rupees in savings.
Okay, I have 10,000 rupees.
And you are presented with two distinct options. Option A is to invest in 5-year postal certificates that yield a guaranteed 8.5%.
Sounds safe.
It is. Option B is to put the money in a 5-year fixed deposit at a nationalized bank that yields a guaranteed 9%.
And the crucial element here is that both of these are government assured, right?
Okay.
The risk profile is identical. They are of comparable risk.
Yes. So if you wake up one morning and decide to choose the 8.5% postal certificate, you haven't just made a choice.
You've actively chosen to forego the 9% bank deposit.
Precisely. By making that specific choice, you incur an opportunity cost equal to the return of the foregone option. Your opportunity cost is 9%.
Let me throw an analogy in here to make this concept of opportunity cost violently clear for the business students listening.
Let's hear it.
Think of it like choosing between two equally demanding, equally prestigious summer internships.
Okay.
Let's say one is at a top-tier management consulting firm in New York, and the other's at a massive, hyper-growth tech giant in Silicon Valley.
Very different vibes, but comparable prestige.
Exactly. But you only have one summer. You can only physically be in one place. The cost of choosing the consulting internship isn't just the sweat, the grueling hours, and like the airfare to New York.
Right.
The true fundamental cost is the exact value, the salary, the networking connections, and the specific resume prestige you walk away from by not taking the tech giant internship.
Ah, I see.
That ghost internship, the one you didn't take, is your opportunity cost. You pay for your choice with the ghost of the alternative.
That is a phenomenal way to visualize it. You pay with the ghost of the alternative.
Right.
Because in corporate finance, the cost of capital is literally the opportunity cost of the capital used by the firm.
It's what the investors could have earned elsewhere in an entirely different investment of similar risk.
Exactly. If an investor gives your company $1 million, the cost to your company is the 10% return that investor could have easily gotten by putting their money into an index fund of comparable volatility.
And if you can't give them more than that ghost alternative, well, they'll just take their money back.
They absolutely will.
So let's talk about the boardroom reality of this. If this cost of capital is just a minimum benchmark, like an invisible line in the sand, what happens when a company miscalculates it?
Oh, it's disastrous.
Say the CFO's office messes up the assumptions. They set the hurdle rate at 6% when, based on the market risk, it really should have been 10%.
Right.
And because the hurdle is artificially low, they accept a massive expansion project that comes in at a 7% return. What happens?
This is the exact scenario that keeps board members awake at night. Miscalculating this benchmark actively systematically destroys shareholder wealth.
Because 7% is better than their fake 6% hurdle.
Exactly. If management sets the hurdle too low, like your example of 6% instead of the true 10%, they will enthusiastically greenlight value-destroying projects.
Wow.
They're essentially borrowing money at a true structural cost of 10% and investing it at 7%.
So they're bleeding 3% of cash on every dollar they deploy.
Yes, but because their internal benchmark is broken, they are celebrating a perceived 1% victory.
That is insane. They are marching the company toward insolvency while patting themselves on the back.
They're popping champagne while the ship sinks.
And the reverse is equally catastrophic, isn't it? Like, what if they are too conservative?
It's just as destructive, but in a different way. If they miscalculate and set the hurdle artificially high...
They think their cost of capital is 15% when the market reality is only 10%?
Right. They will look at perfectly good, highly profitable projects that return, say, 12%, and they will reject them.
Oh, because it didn't clear the FH 15% hurdle.
Exactly. They will leave massive amounts of profitable growth on the table. They will hoard cash, stagnate, and allow competitors with better math to swoop in.
And just steal their market share.
Yep. Whether you set the bar too high or too low, bad math leads directly to fatal corporate strategy.
Okay, that perfectly frames the stakes.
Hmm.
We know why this matters. The survival of the firm depends on getting this right.
Absolutely.
So let's look at the actual ingredients that make up a company's funding. We're going to examine the 4 pillars of corporate finance.
Starting with the most common one.
Right, the first, funding pillar. And traditionally, the most straightforward way companies raise massive amounts of capital is by borrowing it. Let's explore the cost of debt, which the text denotes as K sub D.
Debt is the foundational lever of corporate expansion. It takes the form of debentures, corporate bonds, or, massive term loans from syndicated financial institutions.
Sure.
When a company issues these debt instruments, they do so at a specified interest rate, which the financial world calls the coupon rate.
So if it says 10%, that's the coupon rate.
Right. And this immediately creates a legal obligation. It creates strict creditors for the company.
But when we calculate the actual cost of debt for the firm, we don't just look at the coupon rate the bank is charging them.
I do not.
We don't just say the bank charges 10%, so the cost is 10%. There is a massive structural advantage to corporate debt that alters the mathematics entirely. We have to talk about the tax shield.
Yes. The tax shield is arguably the single most important mechanism to grasp when dealing with corporate debt.
Break that down for us.
Under the tax codes of almost every major economy, the interest a company pays on its debt is treated as a tax-deductible business expense.
Meaning it comes out before the government takes their cut of the profits.
Exactly. Every dollar of interest paid reduces the firm's overall taxable income. In essence, by allowing you to deduct that expense, the government is actively subsidizing a significant portion of your borrowing costs.
I want to break down the text example of Star Ltd. to show exactly how powerful this subsidy is.
Okay, let's do it.
Star Ltd. goes to the market and borrows 5,000 rupees for 5 years at a 10% stated interest rate. The raw math is simple. 10% of 5,000 is 50,000 rupees in annual interest payments.
Simple enough.
Now, if this company operates in an environment with a 30% corporate tax rate, what is the actual bottom line cost of that debt?
Well, if a novice manager just looks at the loan document, they see a before-tax cost of debt, which the formulas call K sub E of 10%.
Right.
But because that 50,000 rupee interest payment lowers their taxable income, it shields a portion of their revenue from that 30% tax.
So they pay less to the government.
Exactly. To find the true cost, we calculate the after-tax cost of debt, denoted as K sub D. The conceptual formula is brilliant in its simplicity. You take the before-tax cost and multiply it by 1 minus the tax rate.
So rather than reciting the algebra, the mechanism is this. Star Ltd. Is paying a 10% rate to the bank.
Right.
But because the government effectively absorbs 30% of that burden through reduced taxes, the company is only bearing 70% of the actual interest weight.
Yes.
10% multiplied by 70% means the true after-tax cost to the company drops all the way down to 7%.
That's a huge difference.
They pay 10% in cash to the bank, but they save 3% in cash they would have otherwise sent to the tax authority. So the net drain on the company is only 7%.
Which is a massive reduction, and it establishes an absolute unbreakable rule for MBA students. When you are calculating the overall weighted average cost of capital for a firm, you must never, ever use the stated coupon rate.
Never.
You absolutely must use the after-tax cost of debt. If you forget the tax shield, your entire valuation model is useless.
It's an instant fail on an exam. Now, the text dives into the nuances by dividing debt into 2 distinct categories, right? Irredeemable debt, also known as perpetual debt, and redeemable debt.
Correct.
Irredeemable debt is a fascinating theoretical construct. It has no maturity value. The company never, ever repays the principal amount. They just pay the interest forever until the end of time.
Which is pretty rare in practice, but conceptually important.
Right. The calculation for that is relatively straightforward.
Right.
It's just the annual interest divided by the net proceeds the company received, adjusted for that tax shield we just discussed.
Yes.
But I want to spend our time on the second type, redeemable debt, because the formula that text provides for this is an absolute monster.
Oh, it is a massive equation. But redeemable debt is the reality for, 99% of corporate borrowing. It has a very specific maturity date, say a 10-year bond, at which point the entire principal amount must be repaid to the creditors.
Right. But when you look at the redeemable debt formula, it factors in the annual interest, the redeemable value at the end of the term, the initial sale value, the flotation costs, the specific number of years to maturity. I mean, it's a sprawling algebraic mess.
It definitely looks like one.
My question is, why? If a company borrows money at 10% for 10 years, isn't the cost over those 10 years just 10% minus the tax shield? Why are we dragging all these discounts, redemption premiums, and years to maturity into the equation?
That is the perfect question to ask because it moves us from theory into the gritty reality of investment banking.
Okay, lay it on me.
The reason the formula expands into that complex structure is because it has to account for the friction of raising capital.
The friction.
The hidden fees. Think about the physical reality of a bond issuance. When a corporation decides to issue a 1,000 rupee bond to the public, they almost never get exactly 1,000 rupees deposited into their corporate checking account.
Because of the middlemen.
Precisely. To raise that money, the company has to hire investment bankers to underwrite the issue. They have to pay high-priced corporate lawyers to draft the prospectus.
Exchange fees, regulatory fees.
All of it. These are all categorized as flotation costs. On top of that, to entice institutional investors to actually buy the bond, the company might have to issue it at a discount.
Right, like they might sell a bond with a 1,000 rupee face value for only 980 rupees.
Exactly. Or, on the back end, they might promise to redeem the bond at a premium, promising to pay back 1,050 rupees at the end of the 10 years.
So the fundamental issue is a mismatch between the face value of the contract and the actual cash changing hands.
That's it entirely.
The company signs a paper saying they borrowed 1,000, but after the bankers take their cut and the discount is applied, maybe only 950 actually hits their treasury account. And 10 years later, they might have to hand over 1,050.
Exactly. And this is why the simple interest rate is a lie. If you receive significantly less cash up front, and you are legally obligated to pay significantly more cash at the very end, your true effective percentage cost of borrowing is much, much higher than just the stated coupon rate on the bond.
That makes a ton of sense.
What that massive redeemable debt formula is actually doing is capturing this exact cash flow reality. It takes the annual interest payment and then it amortizes or spreads out that painful difference between the final redemption value and the initial net cash received over the entire lifespan of the bond.
So it blends the annual interest with the annualized pain of those hidden fees.
Yes, to reveal the true effective annual cost of the debt.
That makes complete sense when you visualize the cash flow. It's not about the percentage printed on the certificate. It's about the physical cash that enters the building versus the physical cash that eventually has to leave the building.
Cash is reality.
So that covers the first pillar. Debt is powerful, and it is relatively cheap because the government acts as a silent partner, subsidizing the cost through the tax shield.
But debt is dangerous.
It is a legal straitjacket. What if a board of directors wants to raise capital without taking on the strict, unyielding, bankruptcy-inducing legal obligations of a bank loan?
Then they have to look elsewhere.
That brings us to the second pillar, preference capital, the hybrid sibling.
Preference capital, denoted as K sub P, is a truly fascinating instrument because it lives right in the gray area. It sits right on the boundary line between the rigid world of debt and the chaotic world of common equity.
But in many ways, it behaves exactly like debt, right?
It does. Preference shareholders are promised a fixed, specified dividend rate. The certificate might say 8% or 10%, very much like a bond coupon.
And crucially, they get paid before the common equity holders are legally allowed to receive a single dime. They stand at the front of the line.
Hence the name preference. They have preferential treatment over the common owners.
Right, they do. But here is the vital defining difference from debt. And this is a concept that trips up business students constantly, right? Preference dividends are paid out of the company's profit after corporate taxes have been fully calculated and paid to the government.
Yes. There is absolutely no tax shield for preference capital. The government does not care about your preference dividends. They do not subsidize them.
So the mechanism we used for debt taking the cost and multiplying it by 1 minus the tax rate completely disappears here.
It vanishes. The cost of preference shares is automatically computed on an after-tax basis. Because there is no government subsidies softening the blow, the post-tax cost of preference capital is almost always structurally higher than the post-tax cost of debt.
even if the stated percentage return printed on the certificates is exactly the same.
Exactly the same.
Let's ground this with the XYZ Ltd example from the text, focusing on the friction of raising the money.
Good idea.
XYZ Ltd decides to issue 8% irredeemable preference shares. The par value, the face value, is 100 rupees. The company manages to sell it at a premium to the public, pricing it at 105 rupees. However, the investment bankers take a flotation cost of 3 rupees per share.
The first step is to figure out the actual cash hitting the treasury, the net proceeds.
Right, because cash is reality.
Exactly. The company successfully demands 105 rupees from the investor, but the bankers immediately take 3 rupees at the door. That leaves the company with 102 rupees of actual usable net proceeds per share.
And the cost calculation is essentially the annual obligation divided by those net proceeds. The promised dividend is 8% of the 100 rupee face value, which is a hard 8 rupees.
Right.
The company has to pay 8 rupees every single year, indefinitely, for the privilege of holding on to the 102 rupees they actually received. So we divide the 8 rupee obligation by the 102 rupees in the bank.
And what do we get?
The result is a true cost of 7.84%.
Notice the dynamic there. The true cost of 7.84% is actually slightly lower than the stated 8%.
Why is that?
Because the company's management team was skilled enough to sell the shares at a premium. They netted more than the face value, even after paying the Wall Street toll booth, which dilutes the effective percentage cost of that 8 rupee annual payment.
That makes sense. But let me pause and ask a strategic boardroom-level question here. Put yourself in the shoes of a CEO. You look at your financing options. You look at debt. Debt gives you a massive tax break. Debt is mathematically structurally cheaper.
Yep.
Then you look at preference shares. The math explicitly proves that preference shares are more expensive than debt because there is no tax shield.
Undeniably.
Why on earth would a rational executive team ever willingly choose to issue preference capital and pay a higher cost?
This touches on the absolute essence of corporate survival. It is the eternal trade-off between cost and risk.
Okay.
Debt is cheap, absolutely, but debt is utterly unforgiving. If a company hits a macroeconomic rough patch, say a global pandemic hits or supply chains freeze, and they miss a single interest payment on a bond,
The bondholders have the legal right to force the company into immediate bankruptcy.
they can seize the assets, liquidate the firm, and fire the CEO. Debt is cheap, but the penalty for failure is death.
A missed debt payment is a default. The game is over.
Exactly. But what happens if that same company hits a rough patch and they miss a preference dividend payment?
I mean, the shareholders would be mad.
They will be furious. Depending on the specific contract, those missed dividends might accumulate in arrears as a growing liability, and the board is legally prohibited from paying a single penny to the common shareholders until every single missed preference dividend is paid in full.
They don't die.
They don't go into bankruptcy. The company survives to fight another day. When a CEO issues preference shares, they are essentially buying survival insurance.
Oh, wow.
They are willingly paying a premium, the higher cost caused by the lack of a tax shield, in exchange for financial flexibility and breathing room during a crisis.
They are trading the cheapness of debt for the flexibility of survival. That is a brilliant way to conceptualize it. You pay more to ensure no one can turn the lights off if you have a bad quarter.
Precisely.
Okay, we've covered the first two pillars, debt and preference capital. Both of these instruments have fixed, predictable payouts. We know exactly what the obligation is.
Now it's complicated.
Yeah, now we have to wade into the deepest waters. The heavyweight division, the third pillar, the most difficult, the most theoretically complex, and universally the most expensive source of funding. The cost of equity capital, denoted as KSOB.
This is the absolute core of modern finance. Common equity shareholders are not creditors. They are not preference holders. They are the actual ulti-owners of the enterprise.
Right.
The fundamental objective of the firm, legally and strategically, is to maximize their wealth. The cost of equity, KSOB, is defined as the minimum rate of return that a company must earn on the equity finance portion of an investment to keep the market price of the common share unchanged.
But here is the massive intellectual hurdle for students. Unlike bonds or preference shares, common equity doesn't have a fixed coupon rate.
There is no legally required dividend.
Exactly. The company doesn't promise to pay you 8%. They don't promise to pay you anything at all. They just promise you a pro rata share of whatever profit is left over at the very end after every employee, every supplier, the government, the bondholders, and the preference holders have been paid.
The residual claim.
Right. So how in the world do you measure a cost when absolutely nothing is guaranteed?
That is the ultimate challenge of valuation. Because equity returns are based entirely on investor expectation rather than a written legal contract, financial theorists and Nobel laureates have spent decades developing methods to estimate it.
And the text outlines 4 distinct methods.
Yes, and each one attempts to capture the psychology of investor expectation from a slightly different angle.
Let's explore these frameworks. Method 1 is the dividend yield method.
This is the most basic foundational approach. It assumes that the cost of equity is simply the discount rate that equates the present value of all expected future dividends with the current market price of the share.
Which means?
The conceptual formula is D1 divided by P0, meaning the expected annual dividend per share divided by the current price of the stock on the open market.
Okay, let's use the ABC Ltd example from the text.
Yeah.
The market expects ABC Ltd to distribute a dividend of 20 rupees per share next year. The current market price of the stock is trading at 120 rupees,
So the math is 20 divided by 120.
which equals roughly 0.167 or a 16.7% cost of equity. The investors are paying 120 to get 20, so they demand a 16.7% yield. But there is a glaring, massive flaw with this method in the real world, isn't there?
A fatal flaw. The dividend yield method assumes that the 20 rupee dividend will remain completely constant forever.
It assumes a state of zero corporate growth.
Right. But that violates the very premise of equity investing. An equity investor takes on massive risk because they expect the returns from their investment to grow over time as the business innovates, expands into new markets, and increases its profits.
If a company's profits are compounding, the cash it returns to shareholders should compound as well,
Exactly.
which perfectly sets the stage for method 2. The dividend growth model, also widely known as the Gordon growth model. This method attempts to fix the zero growth flaw by mathematically injecting a constant growth rate, which we call G, directly into the yield calculation.
Right. The formula evolves into D1 divided by P0 plus G. It recognizes that when an investor buys a share, the current market price reflects not just the cash they will receive next year, but their deep expectation of continuous future dividend growth.
Let's look at the BIL Ltd example to see how growth changes the reality. The market price of their share is much higher, at 220 rupees. The expected dividend next year is still 20 rupees.
But this time, the market expects that 20 rupee dividend to grow at a constant compound rate of 6% every single year.
So we first find the base dividend yield, 20 divided by the 220 purchase price.
Which gives us about 9.09%.
But we don't stop there. We have to add the market's expectation of growth. We add the 6% G factor, add them together, and the true cost of equity is 15.09%.
Notice how the growth expectation profoundly alters the estimated cost of equity. The investors aren't just demanding the baseline 9% cash yield, they are demanding that 9% plus an additional 6% in underlying capital appreciation and growing cash flows every single year.
The company has to work much harder to satisfy them.
They really do.
But wait, this Gordon growth model still relies on a company actually paying out cash dividends. What if I'm looking at a hypergrowth tech startup that reinvests every single penny it makes into research and development and pays zero dividends?
That happens all the time today.
Right. So how do we calculate the cost of their equity when D1 is literally zero?
That is a very real problem in modern markets, which brings us to method 3, the price earnings, or PE method. This framework pivots entirely away from dividends and focuses on the total earnings generating power of the firm.
Okay, how does that work?
It looks at the earnings per share, or EPS, divided by the market price per share, or MPS.
So we are looking at all the money the company made per share, regardless of what they did with it.
Correct. The underlying assumption here is profound. It assumes that the investor capitalizes the entire stream of future earnings, whether those earnings are distributed as cash dividends today or retained by the firm to be reinvested into future growth. The investor assumes ownership of the earning power itself.
So if a company generates 20 rupees in earnings for every share it has outstanding, and the stock price is trading at 90 rupees,
the cost of equity is 20 divided by 90.
which is 22.22%. It's essentially just the inverse of the famous PE ratio you see quoted on financial news networks.
It is exactly the inverse. It's a highly useful shortcut, especially for firms that hoard cash to grow. However, it still has a vulnerability.
Which is?
It relies heavily on accounting earnings. And as any seasoned analyst knows, accounting earnings can be legally manipulated through depreciation schedules and non-cash write-offs. It doesn't always reflect the true, unvarnished cash flow risk of the business.
Right, which finally brings us to the gold standard, method 4, the capital asset pricing model. known universally across every trading floor and boardroom as CAPM.
Ah, CAPM.
This is the undisputed heavyweight champion of corporate finance theory.
CAPM changed the world of finance because it was revolutionary. It completely divorces the cost of equity from corporate dividend policies and accounting earnings. It throws all of that out the window.
What does it look at?
It focuses purely, mathematically, on risk. It dictates that an investor's expected rate of return is divided into two very distinct components: the baseline, near risk-free rate of return, and a specific, highly calibrated risk premium for investing in a particular volatile asset.
Let's lay out the framework from the text. The formula states, the expected return equals the risk-free rate plus beta multiplied by the market risk premium. Let's use the blue line limited example to anchor this in reality.
Okay.
The expected risk-free rate of interest, which usually represents the yield on a stable government treasury bond, is 2.5%. The expected market premium, which is the historical average extra return that investors demand for braving the volatility of the overall stock market rather than hiding in safe bonds, is 5%.
Right.
And finally, the specific beta of blue line stock is 1.2.
To calculate the cost, we build it piece by piece. We take that baseline market premium of 5%. But because Blue Line has a beta of 1.2, we multiply 5 by 1.2, which gives us a specific risk premium of 6%.
Right.
We then add that 6% premium back to the foundational risk-free rate of 2.5%. The total cost of equity under the CAPM model is 8.5%.
Okay, I want to pause the math here. For any MBA student who struggles to conceptualize how CAPM actually works in the real world, I like to use an analogy.
Right.
I view the CAPM equation as building a highly specific risk sandwich.
A risk sandwich. Okay, I'm listening. Walk me through it.
Hear me out. Your bottom piece of bread, the foundation of the entire meal, is the risk-free rate. Think of it as a 10-year U.S. Treasury bond. You get that 2.5% return just for showing up, breathing, and not stuffing your cash under a mattress.
Right.
There is no risk. Therefore, the return is bland. It's just plain bread. Now, the meat of the sandwich is the market risk premium. That is the historical average extra return you get for having the courage to invest in the broader stock market, say the S&P 500, instead of hiding in government bonds.
In our example, that meat is a solid 5%.
Right. So we have the bread and the meat, the foundation and the market baseline.
Where does beta fit into this culinary model?
Beta is the hot sauce.
The hot sauce.
Beta is the mathematical measurement of how sensitive one specific security is to the chaotic movements of the entire market. If your company's beta is exactly 1.0, your stock moves exactly in tandem with the broader market. You are getting the exact same amount of spice as the average market sandwich.
Okay, I follow.
But if your beta is 1.2, like Blue Line Limited, you are putting 20% extra hot sauce on your sandwich compared to the average market. You are telling the market, this specific stock is 20% more volatile, 20% more dangerous than the average company.
And here is the core of investor psychology.
Because it is a spicier, riskier stock, you demand a higher expected return to stomach eating it. So you take the meat, the 5% market premium, multiply it by the 1.2 hot sauce factor to get a customized 6% premium, slap it on top of your 2.5% bread, and boom, an 8.5% expected return. The spicier the stock, the higher the return you demand to hold it.
That is actually a brilliant and highly accurate way to remember the mechanism. What makes CAPM the absolute undisputed gold standard in practice is exactly what your hot sauce analogy captures. It fundamentally understands the difference between systemic risk and specific business risk.
Break that down. What's the difference?
Systemic risk is the risk that affects the entire global economy. Interest rate hikes, global wars, recessions. You cannot diversify away from systemic risk. It hits everyone. The market premium captures that.
The meat.
The meat. But beta captures the specific idiosyncratic volatility of your exact business model relative to that system. CPM captures investor psychology and macroeconomic reality far better than simply assuming dividends will grow at 6% forever.
Yeah.
It answers the ultimate question. Based on how wildly this specific stock swings relative to the entire global economy, what exact percentage do investors require to not sell it?
That brings incredible clarity to equity. We understand external equity now raising brand new money from the public markets. But this leads us directly into what is perhaps the most dangerous misconception in all of corporate finance.
Oh, here we go.
Let's talk about the free money myth, the cost of retained earnings. The text denotes this as case brie.
This is a crucial strategic pivot. Up until now, we've talked about going outside the building to raise money, issuing bonds, selling preference shares, floating new common equity.
But what about the massive pile of profits the company has already generated?
Exactly. The
Yeah.
net profit after tax that is left over after paying all the bills and distributing whatever dividends they chose to distribute. Many students, and frankly, an alarming number of seasoned middle managers, look at this massive cash reserve sitting in the corporate bank account and assume it is free to use for whatever pet project they want.
They think, we didn't borrow it from a bank, we didn't issue new shares and dilute the stock. The money's literally just sitting there. It's ours, let's spend it.
That assumption is not just mathematically wrong. It is a violation of the foundational principles of corporate governance.
Wow.
That cash is absolutely not free. And understanding why is the key to understanding who actually owns a corporation. Retained earnings do not belong to the CEO. They do not belong to the board of directors.
They belong entirely to the common equity shareholders.
Yes. When a firm generates a profit and chooses to retain it instead of mailing it out as a cash dividend, the shareholders are actively, forcefully being denied their current income. They only allow the management team to keep that money if they believe management can invest it internally at a highly profitable rate.
Therefore, logically, the cost of retained earnings is essentially the exact same as the cost of equity. The shareholders expect the exact same rate of return on the money you kept from them as they do on the new money they originally gave you.
Exactly. The expectation does not change just because the money hasn't left the building yet. However, there is one slight mathematical difference in reality, which makes retained earnings highly attractive to CFOs. Retained earnings are slightly cheaper than issuing entirely new external equity.
Why is that? Why the slight discount?
Because of the friction we discussed earlier, flotation costs. If a company wants to issue millions of dollars in new equity, they have to pay the Wall Street toll booth. They pay massive underwriting fees to investment bankers, legal fees, exchange listing fees.
But when a company uses its own retained earnings to fund a project, the money's already inside the vault. There are no middlemen. There is no toll booth.
Exactly. Let's use the text's YPOV limited example to see how this friction alters the hurdle rate.
Let's do it.
The equity investors of YPOV Limited are demanding a desired return of 14% based on the market risk. So the baseline cost of equity is 14%.
Okay.
But if the company decides they need more cash and wants to issue new external equity, the investment bankers are going to charge a flotation cost of 5% of the total amount raised.
So we have two distinct capital pools to evaluate. First, the cost of the cash already in the vault, retained earnings, or KCBRE. Because there is no toll booth to pass through, KCBRE is simply the shareholder's desired return. Exactly 14%.
Right. But for the new external equity, we have to adjust for the banker's cut. Because you lose 5% of your capital at the door, the company actually receives less physical cash to invest.
But the investors still demand their 14% return on the full amount they paid.
Yes. Therefore, the internal hurdle rate has to stretch higher just to cover that missing 5%. The formula takes the 14% baseline and divides it by 1 minus the 0.05 flotation cost. It's 0.14 divided by 0.95.
And the result stretches the true cost of new external equity to 14.74%.
This highlights a massive strategic reality for any corporate board. Retained earnings are the most precious form of capital. They are internal equity. They're cheaper, a clean 14% compared to a bloated 14.74%, strictly because you bypass the financial industry's extraction. And
Hold on, I want to push back on this deeply because this is where theory clashes with daily operations.
okay, push back.
I get the theory. I understand that the shareholders technically own the firm and want a return. But on a random Tuesday afternoon, the CFO isn't writing a physical check for retained earnings. No cash is leaving the building to pay for that capital. The bank account balance isn't dropping just to hold the money.
Right.
Why do we heavily penalize our own internal cash with an invisible opportunity cost on the balance sheet when we are making budgeting decisions? Why treat it like an expensive loan?
That touches on the core absolute fiduciary duty of the executive team. If the company cannot find internal projects, new factories, acquisitions, R&D that can generate that 14% return, they are ethically and legally obligated to return that cash to the shareholder in the form of a dividend.
Just hand it back.
Yes. Why? Because the shareholder could take that cash dividend, walk down the street, and invest it themselves in a competitor's stock of similar risk that is generating 14%. Retaining the earnings isn't a passive, neutral default state. It is an active, aggressive investment choice by management.
I never thought of it like that.
If management hoards billions in cash and invests it in safe, low-yielding projects at 8% just to build their empire, while the shareholders are demanding 14%, management is literally actively destroying the wealth of the people who employ them.
So treating retained earnings as free money is the fastest path to corporate malpractice and shareholder lawsuits.
Exactly.
Wow. Okay, that frames it perfectly. It's not an accounting penalty. It's a profound measure of respect for the owner's wealth. If you can't beat their baseline, give them their money back.
Beautifully said.
All right, we have arrived at the grand finale, the ultimate blender. We have spent an hour deeply examining all our individual isolated ingredients: the subsidized cost of debt, the flexible cost of preference shares, the highly volatile cost of external equity, and the fiduciary cost of retained earnings.
Now we have to synthesize them.
We're talking about the weighted average cost of capital, the WACC.
A company almost never funds a massive transformational initiative, like a multi-billion-dollar acquisition, with just debt or just equity. They use a blended pool of funds from across their entire capital structure.
Therefore, the company needs to blend all these specific isolated costs together to find the one ultimate unified hurdle rate for the entire firm.
Precisely.
The WACC is the average after-tax cost of all sources of capital, mathematically multiplied by their proportional weight in the company's overall capital structure. I like to think of WACC like a master distiller, blending a highly complex whiskey.
I like this analogy already.
You have your cheap, reliable grain alcohol. That's your debt. It's inexpensive, but if you use too much, it ruins the drink.
Right.
Then you have your incredibly expensive, complex, aged single malt. That's your equity. It provides the value, but it costs a fortune. The WACC calculation is the process of finding the exact mathematical proof, the exact overall strength of the final blended bottle.
That is an excellent visualization. And the text outlines 3 clear, methodical steps for this blending process. Step 1, determine the specific after-tax costs of all individual components.
Which we just spent the entire discussion dissecting exactly how to do.
Step 2, assign specific proportional weights to each source of capital based on how much they contribute to the total capital employed by the firm.
Okay.
Step 3, multiply the specific cost of each source by its proportional weight and sum all those products together to get the final WACC.
The conceptual formula looks intimidating, but it's really just a sum of weighted products. The percentage weight of debt times the cost of debt, plus the percentage weight of equity times the cost of equity, and so on.
It's actually very elegant.
But the crucial philosophical debate that a financial manager faces happens entirely in step 2. How do we actually determine the true value of those weights?
Yes, the text highlights a massive foundational debate in corporate finance: book value weights versus market value weights. Let's unpack the profound difference between the two.
Let's do it.
Book value relies entirely on historical balance sheet accounting. It looks at the par values, the original face value of the securities, on the exact day they were issued, which could have been decades ago.
It's an accounting record of the past.
Exactly. Market value, on the other hand, ignores the historical balance sheet entirely. It uses the current real-time trading prices of those securities as they are valued on the open global market today.
To show how drastically different these two philosophies can be, let's contrast 2 examples from the text.
Perfect.
Example 11.15 uses the historical book value method. We have a firm that has 20,000 rupees in debt, 3,000 in preferred stock, and 30,000 in equity shares, based purely on their original par value.
The total book value of the firm's capital is $53,000.
Right. When you calculate the proportions, debt makes up roughly 37.7% of the firm's capital structure, and equity makes up 56.6%. It looks like a fairly balanced mix.
But then look at example 11.16, which uses the exact same underlying company, the exact same number of physical shares and bonds, but prices them at their current market value reality.
What happens?
The debentures are currently trading at a slight discount to par. The preferred stock is trading at a slight premium. But the real shocker, the element that destroys the book value illusion, is the equity.
Let me guess. The stock price went up.
Way up. The firm has 2,000 equity shares. Historically, they were recorded at 15 rupees par. But today, the current market price is 190 rupees per share because the company has been wildly successful.
So the true market value of the equity alone is 3,080,000 rupees.
Yes. The total market value of the entire firm balloons from the historical 53,000 all the way to 4,040,000.
And the weights completely violently flip. Under the historical book value illusion, equity was 56% of the firm. But under the market value reality, because the share price has grown so massively over the years, equity leaps to dominate 86.36% of the firm's total value.
Wild, right?
Debt, which looked like 37% of the company on paper, shrinks to just a 9% sliver of the actual market reality.
This is exactly why market value is highly, highly preferred and frankly mandated in sophisticated corporate finance. Book value is an accounting fiction. It is a ghost of the past. It represents historical conditions that no longer exist.
While market value represents the brutal current reality of what the global pool of investors believes the firm is worth right this second.
Exactly. If a CFO uses historical book value weights when their stock price has quadrupled over the last 5 years, their calculated WACC will be artificially low, wildly inaccurate, and it will lead them to make disastrous, value-destroying investments.
Let's bring this entire deep dive together with the magnum opus of the chapter, example 11.17. Let's walk through a full, comprehensive WACC calculation using market values step by step.
Okay, let's build the whiskey.
Let's imagine the board of directors is staring down a massive new project, and they need their hurdle rate. The firm has 10 million rupees in outstanding debt bonds, currently selling at 106% of par, with investors demanding an 11.3% yield.
Got it.
They have preferred shares currently trading at 95 rupees, paying a 10 rupee fixed dividend. And they have 1 million common equity shares trading on the open market at 112.5 rupees, with the market expecting a 10 rupee dividend that will grow at 5% forever.
Finally, the corporate tax rate is a heavy 40%.
Right. So, step one.
The first step is to isolate and calculate the individual costs of each component based on current market reality. Let's start with the debt. We take the market yield of 11.3%, but we absolutely must apply the tax shield.
1 minus the tax rate.
We multiply 11.3% by 1 minus the 0.40 tax rate. The government absorbs 40% of the burden, leaving an after-tax cost of debt of exactly 6.78%.
Perfect. 6.78% for the debt. Now, the preferred stock.
For preferred stock, we take the 10 rupee fixed dividend obligation and divide it by the net price the company could actually get. The text notes a 5% discount for new issues and a 2.5 rupee flotation cost for the investment bankers, bringing the net realizable price down to 87.75.
So the 10 rupee dividend divided by the 87.75 net price yields a true cost of 11.39%.
And remember, there is no tax shield here.
Right. So we have cheap debt at 6.78 and more expensive preferred at 11.39. Now the heavyweight, the cost of equity.
For equity, we deploy the Gordon growth model. We take the 10 rupee expected dividend and divide it by the 112.5 current market price, which gives us the base yield.
And then we add the market's expectation of 5% continuous growth.
Yes. Notably, the text specifies to ignore equity flotation costs here, because the firm has enough retained earnings cash on hand to fund the equity portion of the project internally. We are bypassing the Wall Street toll booth.
Beautiful. Doing the math, the cost of this internal equity is 13.88%.
Okay, let's pause and survey the ingredients for our master blend. We have debt at 6.78%, we have preferred at 11.39%, we have equity at 13.88%.
The next step is to calculate the total market value of the firm to establish the proportional weights. The total market value of the debt is 10.6 million. The preferred stock is worth 14.25 million, and the equity is a massive 112.5 million.
Add them all together, and the total market value of the entire enterprise is 137.35 million.
Now we find the weights by dividing each specific component by that total, 137.35 million. Debt represents roughly 7.7% of the firm's capital structure. Preferred stock represents about 10.4%. And equity is the overwhelming dominant weight, making up nearly 82% of the firm's total value.
And now, the final step, the ultimate blending of the whiskey. We mathematically multiply the percentage weight of each component by its respective percentage cost.
We take the 7.7% weight of debt and multiply it by its 6.78% cost. We do the same for preferred and the same for the massive 82% weight of equity at its 13.88% cost.
We sum those three weighted products together.
And the final, ultimate, unified weighted average cost of capital for this entire corporate enterprise is 10.49%.
That 10.49% is the magic number. It is the absolute baseline of survival. It represents the blended demands of every bondholder, every preferred investor, and every common shareholder, all adjusted for taxes and market reality.
Any new project this firm takes on, whether it's a new software platform or a new shipping fleet, must generate an internal rate of return strictly greater than 10.49%.
If a project returns 10.5%, they are creating wealth. If it returns 10.4%, they are systematically destroying the value of the firm.
It is a beautiful, elegant synthesis of every single complex concept we've discussed. But I know there are MBA students listening right now who are dreading having to execute this massive calculation under the intense pressure of a final exam.
Oh, the exams are brutal.
I have to ask you about the exam day traps. When a student is calculating WACC under pressure, what are the most common catastrophic mistakes they make when trying to pull all these moving pieces together?
It is almost always a failure of attention to detail regarding taxation and valuation methodology. The single most common immediate failure trap I see is this. Students panic, they look at the debt, they grab the stated coupon rate printed in the prompt, and they plug it right into the WACC blender.
They completely forget to calculate the after-tax cost of debt.
Instant failure. The second most common trap is the exact inverse. They get so excited about the tax shield that they mistakenly apply it to preference shares, forgetting that preference dividends offer absolutely no tax relief.
Oh, that's a painful mistake.
And the third is a conceptual failure. If a devious exam question provides you with a table of historical book values and a separate table of current market values and doesn't explicitly tell you which one to use for the weights, students will often default to the book value because the numbers are usually rounder and easier to work with.
Always use market value.
The market dictates reality. The book value is just a museum exhibit.
Debt gets the tax shield, preference absolutely does not, and the market always dictates reality. Write that down, internalize it, and you will navigate the WACC calculation perfectly every single time.
If you can master those three principles, you truly understand the architecture of corporate capital.
So, to summarize this incredibly deep journey for our learners today, capital is never, ever free. It is a vital, expensive factor of production with a very real price tag based on investor expectations.
Debt is relatively cheap because of the government tax subsidy, but it acts as a rigid straitjacket that can force a company into bankruptcy if mismanaged.
Equity is highly flexible and carries no legal guarantee, but because the owners bear the ultimate catastrophic risk, it is structurally the most expensive source of funding.
Retained earnings, the cash sitting in your own vault, carry a heavy fiduciary opportunity cost that management must deeply respect.
And finally, WACC is the master blend, the ultimate hurdle rate that determines whether a CEO's grand strategy creates wealth for the world or destroys it.
It is the ultimate diagnostic tool. It takes the psychological expectations of thousands of investors, filters it through the tax code, and distills it into a single actionable number.
Exactly. Which brings me to a final, slightly terrifying, provocative thought to leave you with. Something to chew on before your next MBA finance class or your next board meeting. The text briefly mentioned systemic risk when we were discussing PAPM and the market risk premium. Systemic risk is the macroeconomic force that no company, no matter how brilliantly managed, can escape.
Right.
Now think about the architecture of everything we just built. CAPM, the Gordon growth model, the ultimate WACC calculation, they all depend heavily on foundational macroeconomic inputs, specifically the risk-free government bond rate and historical market risk premiums.
Right, the bedrock foundation, the plain bread of your risk sandwich.
Exactly. But what happens to a specific company's mathematically perfect cost of capital, and by extension their entire multi-year strategic plan, when global systemic risk causes those foundational government rates to violently, unpredictably fluctuate? If global inflation spikes and central banks panic and double or triple the risk-free interest rate overnight to combat it, the entire baseline of reality changes.
The bread changes.
Suddenly, the bread is fundamentally different. Overnight, without the company doing a single thing wrong, every corporate valuation model, every carefully calculated WACC, and every single project approval hurdle in the world has to be violently rewritten.
The math gets thrown out the window.
The beautiful precision of our internal math is entirely, helplessly, at the mercy of the chaos of the global macroeconomic system. You can calculate your WACC to 4 decimal places on a Friday and wake up on a Monday to find that the market has fundamentally altered the cost of your survival. Something to think about the next time you look at a balance sheet.
A fascinating, humbling, and sobering reality to end on.
Thanks for joining us on this deep dive. See you next time.